A prerequisite for this video is to review the two short intro videos highlighted by the magenta box titled How to Read Weekly Charts with Decimal Strategic, Part 1, and How to Define Risk-Reward Opportunities, Part 2. This is the third training video titled Strategic Trading with Alpha 1. By the way, please note you will find written transcripts for further study posted on the website below each video. Before we begin, please note two important points. Aspiring traders are often impeded by two major issues related to focus. The first issue is too little focus on trade selection. Marginal trade selection is often a result of poorly designed models or a lack of discipline and impulsive trading. Here's Warren Buffett describing patient trade selection. I call investing the greatest business in the world because you never have to swing. You stand at the plate, the pitcher throws you General Motors at 47, U.S. Steel at 39, and nobody calls a strike on you. All day you wait for the pitch you like, then when the fielders are asleep you step up and hit it. So point one is, to create alpha you must be very selective. Every elite futures trader that I have worked with is very selective, and when they see what they are looking for, they're aggressive. Being selective is critical because it lays the groundwork for being aggressive. If you have dissipated energy and capital on marginal trades, you will not be aggressive when compelling trades come along. The second point is related to something Peter Stottlemyre said in 2012. The idea today is more about order placement, not so much about trading the market. By the way, this is a man who is in his 6th decade as a master trader and innovator. So trade selection, risk-reward analysis, which is what defines order placement, is where all of your energy should be directed and focused. So as you view these training videos, keep in mind that Alpha 1 and Alpha 2 are specifically designed to provide solutions in the form of a focused mechanism for robust trade selection. And the unorthodox charting methods generated by the software is designed to isolate the key data to enable fast risk-reward analysis so one can focus on this core aspect of the business of trading, which is really to place meaningful, effective orders in the market. Decimal was not built and designed for market analysis per se. It was really built as a platform to facilitate order placement. The difference is subtle, yet very important. So let's begin. Now, if you already have a decent trading strategy, then I encourage you to view this video as an example of how you might integrate Decimal into what you're already doing. If you do not have a well-developed strategy, then I encourage you to use this fully disclosed strategic framework outlined here as a launching point. I'm 100% confident that many of you who study this video closely and deploy the rule sets and protocols suggested here and in our other training videos will see your trading skills evolve into viable trading businesses. Let's now proceed by visualizing a schematic of one type of multi-model framework for decision making at a strategic level. We will then use it to define a rule set to identify what a compelling trade opportunity looks like. The first strategic component is Trend Dynamics' 7th law, which is simply an unconventional model based on what we call a semantic pattern rule. We describe the semantic pattern classification of price behavior models in our website. If you go to resources, then choose publications and look for Decimal submodels explained. The 7th law semantic reads, dramatic price movements tend to unfold from price structures that minimize profitable participation. The essence of the 7th law is to identify logical levels where other time frame participants holding inventory long or short are forced to make impulsive decisions or forced to adjust or close positions due to stops being hit. Structural price levels are used to place stops because they're easily visible. In other words, with the 7th law, we're stalking price action that triggers liquidity events and volume spikes, which then create opportunities for us to fade these events and place orders in the market. To use a 7th law semantic, it's helpful to understand how to classify the relative importance of various swing tops and bottoms. We happen to favor swing classifications found in the Trend Dynamics course. However, one may also find alternate means of defining important structural price points. The Edwards and McGee Classic Technical Analysis of Stock Trends, or Ralph Elliott's Wave Analysis, may be a useful substitute as well. We now pair the seventh law with a more conventional component, one where we use a macro time frame moving average for context. Moving averages have historically driven some very successful trend-following models, but they are often ineffective or even dangerous if used mechanically in trading ranges. We suggest tracking the macro trend with a 40-week, which is the equivalent of a 200-day moving average. Paul Tudor Jones of Tudor Investment was once asked, "How do you determine trend?" He replied, "My metric for everything I look at is the 200-day moving average of closing prices." In another interview, he said, "I have one strong rule, and that is when it comes to a stock, if it's above the 200-day moving average, I'm going to be long, and if it's below it, I'm either not going to own it or I'm going to be short it. Period. End of story. And I just let that govern every single thing that I do." This is one of the greatest alpha creators of my generation, and like Jones, we use the 200-day to provide macro context for Alpha 1. Here's a side note. We've been building models for a very long time, since the late 70s. And one of the things that we always keep in mind is when considering using any conventional or non-proprietary model as an input, we advise either using them in unconventional ways or using them at a higher time frame, macro level, because at a macro level they generally do not generate risk-reward equations where the large implied risk is practical for most participants. However, they can still be very valuable as a contextual input, as we'll illustrate here. And the same can be said for conventional Edwards and McGee chart patterns such as head and shoulder formations. They can be useful in a macro context, but tend to be far less useful at a localized or lower time frame level. So the strategic framework we're describing pairs two models, one unconventional and one conventional, which will be interactive. Next, we wrap the decimal alpha 1 around these two models as an overlay or a filter, which adds more models into the mix and imposes a trade selection algorithm or discipline by virtue of alpha 1 or alpha 2 signals. The alpha 2 protocol will be covered in another video. Finally, we add the secret ingredient, the life plasma at the very core, which is to base all actions and to define our order placement based on risk-reward relationships, because, as Jones predicates, the genesis of all profitable trading is creating favorable risk-reward trades. So now, based on this construct, we can articulate a rule set that is as simple as possible, but no simpler. This rule set controls how we intend to make decisions around our model construct. We'll call this example the Alpha 1 default rule set. It reads as follows. Scan your watch list for weekly Alpha 1 signals coincident with 7th law semantic pattern upthrusts or springs. 2. Assess macro trends. 3. Monitor for an intra-week range bias or weekly price rejection if Alpha 1 signals are still active. 4. Draw potential and active risk-reward grids as soon as possible to anticipate order placement and size the trade. 5. If the risk-reward grid is activated, place the entry and stop order. 6. If the entry is filled, then place a take profit order. And 7 is to manage the trade or core unit mindful of number 2 above, which is the macro trend. Keep in mind these 3 points. I worked for a decade every day with George Peacock, who is a private money manager and one of the best S&P futures traders I've ever met. He used to say, if one can isolate a trade where there's a high probability of price moving quickly in your direction, a lot of good things can happen. The second point is in modern markets where opportunities are transient and everybody has access to current pricing, if a high probability setup for near-term profits develops, one with a real edge, you're far more likely to be offered an entry in what we call the alpha entry zone, which is the 1-to-1 to 1-to-2 zone. If you look for the standard 1-to-3 risk-reward ratio or greater all the time, you're going to miss a lot of trades, and this applies to swing traders or intraday traders. Now, the operative phrase is high probability. I'm only talking about true high probability trades here. If it's a more random or lower probability situation, then perhaps a 1-to-3 or higher risk reward zone is more optimal. But if you really know what you're doing and you follow the type of rule sets we define in these videos, then this alpha zone we demonstrate is the sweet spot. Point 3 is a partial to core ratio near 60% is ideal. So if you initiate a 5-unit position and book near-term profits on 3 units, then you still have a decent residual 2 units to capture outlying risk reward on that 2-unit core position, and the profit on the 3 units secures a win, frees up margin capital for another trade, and allows one to manage a core position with greater detachment. Alternately, if you initiate a 3-unit position and book near-term profits on 2 units, then you have a residual potential on a 1 unit to manage. Now, with the default rules set for Alpha 1 as our guide, let's walk through a typical strategic trade generated by Alpha 1. This is a methodical thought process and analytical style that we suggest subscribers emulate, at least initially. One should set up a watch list for the universe of assets or names that you trade and scan your weekly charts for alpha signals every weekend to prepare for the following week's trading. For those who are unable to run Decimal software, as an option you can subscribe to Decimal Select, which is a weekly report featuring potential Alpha 1 and Alpha 2 trade setups, which you can incorporate into your existing trading operation. You are now looking at a weekly SU price action for Suncor Energy and oil stock. The bar at X, the week of November 21, 2014, has just closed, and you notice an Alpha 1 signal overhead at A with the clock just reset to 1 o'clock on the sell side. Even though it's the 4th red dot, you know it's not a 4 o'clock dot because the black dot inside of the red dot below A indicates a 1 o'clock reset. I strongly advise that you avoid trading decimal in isolation, which means that you always extend your view to incorporate a big picture technical narrative for the assets you're trading. Let's do that now. Taking in a bigger view, we can see the technical narrative. On the left at A3, we see a lower swing top developed, which was a deviation in trend, meaning a deviation from the pattern in the first half of 2014 of higher swing tops and higher swing bottoms. That deviation in structure led to a decline to B4, which turned the weekly trend down. The next rally to A4 reset the clock to 1 o'clock, followed by a sell side vector control, a fire bar, a red fire bar, and an Alpha 1 sell that was contra trend to the 200-day at the time, but with a weekly downtrend. The Alpha 1 led to a collapse through B4 and down to B5, turning the 200-day down in earnest. So now we see the Alpha 1 signal was part of a correction back up toward the 200-day moving average, suggestive of an attractive post-change retest of the 200-day trend change. So following our checklist, this Alpha 1 is definitely with the 200-day macro trend, but does it also engage the 7th law? Recall the 7th law as a semantic-based submodel proposes that dramatic price movements tend to unfold from price structures that minimize profitable participation. Given this weekly chart for Suncor Energy, the 7th law semantic works like this. Assume some swing traders are short from the second lower top at A4, and others are short on a technical equivalent to the fire price bar below the Alpha 1. More are short on the break of B4, and even more shorted for the weakness on the weekly close below B4. If those shorts are swing trading versus structural tops and bottoms, then they have to, by definition, allow for a possible retest or correction back up as high as A4, because such a correction could develop into a third lower top. I have drawn that hypothetical retest or swing in light blue at the question mark. So a lower top to the right and below A4 would not violate the current structural pattern of lower tops and lower bottoms. So from a structural point of view, the stop must be retained above A4 to allow for a sharp counter trend rally, because in bear markets, rallies can be very sharp. That's very typical. After the decline from A4 to B5, those shorts have large open profits and may book some of those profits. However, if they are trying to stay short with the trend, then even at B5, based on swing analysis, the stop should not be lowered until a new lower swing top is defined. When does that actually occur? As the Trend Dynamics course explains, you do not know that a swing bottom is formed at B5 until the moment the 5-day weekly range is breached to the upside at Y by a threshold level of points. And as price extends higher to A5, you can't, from a technical point of view, lower the trailing stop from A4 quite yet, because you do not know whether the high at A5 is in fact a lower swing top or whether it extends higher. It is only at X, when the low of the A5 week is breached, that we can define the B5 to A5 movement as a definitive swing and define with certainty that a lower weekly swing top at A5 is in place. Up until that very moment, we only know the swing is still rising from B5 because any intra-week move toward the low of the A5 bar could be just minor or a noise. Therefore, from a technical point of view, it is not until the A5 weekly range low is broken in earnest at X that an actual lower top is in place at A5, and only then would swing traders lower stops down to above A5. And this is when the seventh law semantic comes into play, because any upthrust of trailing stops, which are lowered to A5 to preserve open short profits, is the market's way of minimizing the ability of those shorts to remain short or to maximize any further participation to the downside. And it creates a liquidity event, and that event is the essence of the seventh law semantic, which provides an opportunity for us to rejoin the major trend and the short side at a dynamic point in time and price. So the seventh law semantic is an important submodel or component of the Alpha 1 protocol that we recommend. As a final note, notice we're stuck in the Alpha 1 signal indicated at 2, but there's also an Alpha 1 signal at 1 2 weeks prior. Why does that signal not qualify? The answer is that until A5 is upthrust, no seventh law semantic is in place. Back to our Alpha 1 default rule set, we have at 2 an Alpha 1 signal which aligns with both the 200-day macro trend and the seventh law semantic. So at Z, during the week of November 24th to 28th of 2014, we are monitoring intra-week price action to see if a weekly top may be developing during the week of the Alpha 1 signal. At the same time, we are drawing potential risk-reward grid to define the high probability targets below to take partial or whole profits. Looking at the weekly chart, this weekly chart, we do not see a clear tree bar below with a 3 or 4 o'clock vector below to define an alpha zone target, as explained in the first training video titled How to Read Weekly Charts. In the absence of a tree bar or clock generated target, what does one do? We recommend using a trend dynamics based quadrant target. In the second training video titled How to Define Risk Reward Opportunities, we described modifying a fib retracement tool to create a visual risk reward grid or risk reward calculator. Fib retracement tools are normally a standard tool for most charting software. Before we modified the tool by adding the 0.50 and 0.66 as at A and B, now we add a 0.25 level indicated at C. We use 5 primary techniques to target NTLs, which are non-trend liquidation price targets. Quadrant targets are one of these 5 methods. By NTL, we mean profit targets based on an assumption that a trend does not reassert itself and extend to new lows or new highs. NTL, or non-trend liquidation targets, have a much higher probability of being tagged than trend-based targets, which assume a new high or low. Especially in markets they may trade in trading ranges for extended periods, or markets like the S&P 500 that tend to be very rotational. By the way, to review these 5 techniques in one setting, look for a publication titled The Wu Jing of Profit Targets in the Publications section located in Resources at the Stock-Zen website. Identifying a high probability target is a very important skill because our risk-reward grid protocol uses these targets to define the entry zone. Further, you need more than a single tool to define a high probability profit target accurately, and you need to train to be proficient in all five, as price action at lows and highs can develop in different ways, and these 5 techniques provide a flexible tool set. Another reason we offer and demonstrate 5 different tools is to prevent traders who lease decimal from placing entry orders at the same exact price level, which would be the case if we offered one specific precise tool for calculating an exit. A quadrant target for Suncor Energy would be calculated like this. First, I take the high of the swing to date at A, which is the Friday of the week ending 11/21/14, and anchor the risk-reward grid, then stretch the target line, the blue line, initially down to the low of the range in question, which is Wednesday of the week ending 10/17/14 at B. This identifies the lower quadrant of the A to B range as C. Next, I use a line drawing tool to superimpose a line at the price level identified as the lower quadrant. In this case, I drew a white dashed line at C. Then I re-anchor the blue line from B and move it up to the C level. This adjusts the alpha zone, magenta and yellow lines, the alpha zone entry zone above to the correct level relative to our quadrant target below. Now that we have our risk-reward grid drawn properly with our blue line target level at the lower quadrant target, let's return to our entry protocol. We have identified an alpha 1 signal that meets our default rule set. We know the macro trend, the 200-day, is down, and the price action has triggered a 7th law semantic. So now we're just focused on intra-week daily price action to validate the alpha 1 signal. By the way, you may have noticed this daily chart, like the weekly, is charting decimal-based price action in terms of fire and tree bars, clock vectors, and alpha 1 signals. This feature is not available with the entry-level or basic version of Decimal. It's part of the professional version. If you have the basic version, you can use intra-week range development as an entry tool, as illustrated here, which is independent of Decimal, or your own in-house entry protocols to validate the alpha 1 signal in a daily price action. So the green tree bar at A is the Friday, November 21st of 2014 daily price action for Suncor. It resets the daily clock, and this could be a bull trap. If so, we need to see a performance demand for the weekly range for November 24th to November 28th to develop to the downside as price rejection. On this daily chart, every Monday bar is indicated by the thin vertical black line. After Monday, we notice daily sellers defending the sell side clock vectors, and we now have drawn in our quad target grid already in anticipation in case we need to act swiftly. Coming into Wednesday, the Monday-Tuesday range is broken to the downside, suggesting there's an 80% probability that the high of the week is already in. This price event is occurring in the alpha entry zone and closer to the magenta 1 to 2 risk reward level, and we know the macro trend is down, and the 7th law semantic has isolated a potentially dynamic price action as shorts have just been minimized. So we have a high probability of taking partial profits at our quad target at X, quad level at C, and enter short with a stop placed some distance above A, and a second order to cover shorts on the thrust down to the alpha zone target at X. We cover 3 of 5 units or 2 of 3 units and try to manage the core for outlying trend-based profits. Question: exactly where should I place a stop? You should place a stop some distance above A, not exactly at the A level. This is because you should allow for a minor intra-week upthrust to the high, even after entry, to allow for a more perverse effort to minimize your short side participation as well as the participation of others in a move to retest lows. We do not provide exact specifications for the stop for the same reason we don't provide a single tool to calculate profit target levels. That being, we and existing clients are using Decimal every day, and we want to prevent orders from aggregating at the same levels that we're trading. As a final note, we are also rationing Decimal leases in 2 ways. 1, by limiting Decimal to a maximum of 200 lessees, and we may reduce that number if our orders are affected. And 2, by reserving the right to charge any established professional or institutional client an institutional rate to lease the software. We define who we consider a professional or institutional client in the terms specified in our pricing policy, and a link to that is provided when clients sign up. Traders who have completed the Trend Dynamics course also have priority. This concludes Strategic Trading with Alpha One, the third in our 5-video decimal training series. Next up, please proceed to review and study the Tactical Trading with the Alpha 2 video. For further study of Alpha 1 trades, please visit the Trade Archive found in the resource section of our website and review all Alpha 1 trades in that archive. You should also sign up for our mailing list to receive updates of new decimal trades in progress. To extend and refine your skill set, please explore both the publications section and the decimal training area of our website located in the resources section to locate additional training material.